One of the big themes this quarter was in the Middle East. The focus shifted from the war towards more reconciliation, the fact that there was ongoing negotiations and eventually a ceasefire by the end of the quarter. Oil prices dropped significantly, returning very close to their pre-war levels. And what that meant, it was risk on for equity markets. One of the strongest equity markets since 2020. The AI trade came back into vogue. In particular, shortages in memory chips was the area of focus, with many of the key players and manufacturers of memory chips seeing their stock prices more than double over the course of the quarter. That meant that US markets led the way higher amongst developed markets. Emerging markets even outperformed further given exposure to Korea as well as Taiwan, where of course many of the semiconductor companies are listed. At the same time, we saw the largest ever IPO this quarter, with SpaceX launching their shares and actually seeing further 25% gain in shares trading in the open market over the course of the quarter. With two more mega IPOs planned over the course of this year, with of course Anthropic and OpenAI, many have raised concerns that perhaps we're reaching peak valuations, maybe the markets are primed to roll over, which is a fair point. In prior major market tops over the last couple of decades, when we've seen very high levels of IPOs, it's often coincided with a top in the market. However, this time around, despite these three very large IPOs, total deal activity is actually not quite as high as it was in those periods. So through much of this year, with higher oil prices and the conflict in the Middle East, we saw bond yields rising given the inflationary concerns with higher oil prices. And of course, rate expectations for central banks around the world were ticking higher and higher. Now, despite cessation in hostilities, a ceasefire, falling oil prices, a couple of things have kept bond yields and rate expectations relatively elevated. One thing is consumers have yet to see that full impact of, although crude prices are back to where they were pre-war, prices at the pump only down, around 15% in many markets. So as usual, consumer prices are quite sticky on the way down. At the same time, with the new Fed chair, it surprised the market a little bit that he struck a considerably more hawkish tone than he did leading up to his nomination for the role. So all of that has conspired to keep rate expectations relatively high, bond yields relatively high, continuing much of what we've seen since the 2021 era of higher for longer, where fixed income within a portfolio primarily serves as an income generator, and you're seeing much better levels of yield than certainly investors were accustomed to in the prior decade. And with those more attractive yield levels, investors are essentially getting paid to wait for that potential need for insurance in the portfolio. So right now, the base case is that the economy remains relatively resilient. But if things were to deteriorate and that unexpected sort of slowdown in the economy were to occur, then you would expect to see bond prices rise as rate expectations fall, getting that portfolio benefit through diversification. So the well-diversified asset mix of the Granite Portfolios contributed to a very strong quarter and allowed us to participate well in that upside in a very strong market for equities. So particularly exposure to US markets and a very healthy strategic exposure to emerging markets led to the upside. At the same time, from a tactical perspective, as we entered the quarter, our sentiment signals were pointing to excessive pessimism in the market. And all of our work has shown that when markets are excessively pessimistic, it's a great opportunity to go against the herd, add some risk to portfolios. We actually took a fairly significant overweight position in US equities that we held through much of the rally through April and May before taking profits as we entered the month of June. Finally, while commodities were a drag in the portfolio, both tactical and strategic positions that we hold in commodities, we saw other parts of our real asset exposure, particularly real estate, post some very strong gains and more than offset actually that weakness in commodities. So again, the net benefit of diversification across the portfolios allowed for that upside participation. While investors often become concerned about a market sell-off after we've seen some really strong gains over a short period, as well as sitting at relatively elevated valuations, our base case is still that growth assets can continue to move higher from here, really on the back of a strong economy that's still quite resilient, and that's driving earnings growth at the end of the day, which is leading to stronger equity markets. At the same time, you have that tailwind which is really a secular theme around the buildup of AI, which is just adding some additional impulse for markets. So that's the base case, but of course we construct our portfolios for adverse scenarios as well. As an example, if our expectation right now is that inflation is beginning to moderate as consumer prices kind of catch up to lower oil prices. If there is another bout of inflation, that's why we have assets such as commodities, such as real assets in the portfolio to help mitigate that exposure to higher consumer prices. At the same time, right now we expect growth to be fairly resilient. If we were to see a downturn in growth, again, something that's not our base case, the high quality fixed income in the portfolio provides some ballast. As yields fall, we would see those assets appreciate in value. And then throughout our investment process, we do have our tactical process as well. So we're continuously monitoring the market, looking for opportunities where sentiment may be getting excessive that allows us to dial up and down the total risk in the portfolios. At the same time, we have various models designed to look at opportunities to dial up and down our commodity exposure, and then finally rotate between different segments of the equity market. So these various levels of diversification, different time horizons as well, allow us to be quite comfortable that the total portfolio construction can participate in our base case, but also protect in some of those adverse cases.